My name is Karim Galani, and I'm a VC with Luge Capital. I'm one of the co-founders and general partners, and we invest in early-stage fintech companies across the US and Canada. If you're thinking about starting a business, if you're going down the path of raising venture capital money to support the growth of a new business that you want to run, make sure you have big ambitions. It is a tough and lonely road, and it can throw a lot of curveballs at you. But what's really important is you gotta stay focused, have big ambitions, and aim to be the best in the world at what you do. Anything less, and it's not worth it. Today on the Start Well podcast, we're going to talk about new innovations in fintech, how AI is impacting those innovations, how companies get built, and how they grow to become long-lasting businesses.
Welcome to the show, man.
Thank you.
Yeah.
It's great to be here.
It's awesome to have you back at Startwell. I think
Appreciate it.
the last time you were here, I feel like we were whiteboarding on glass, and that was like years ago downstairs.
That sounds right.
And you were explaining the whole like global financial system to me. Are you as excited now as you were 5
even
years ago?
more so?
Yeah.
Even more so. I remember when you opened this place up, I used to live right across the street. You remember that?
2017.
Yeah. When our son was born.
World of difference. Wow, that long ago?
Yeah.
Holy smokes.
Yeah.
Yeah, and a lot of changes happened, and now we're in a happy place between, media production and
That's great.
and events, corporate events. And I've integrated them. I'll show you on the way down.
Yeah, that'd be great.
Because all the venues have cameras built into them. And it's something that we're big on, right? It's like any opportunity when you bring people together is an opportunity to share the story with other people. And that's
Excellent.
what we champion. So yeah, I would love to hear so much from you to set this up, a little bit for our audience. Can you give me the quick bio data on like your career history that brought you to where you are? Just the cliff notes of like venture and finance stuff.
Yeah. So I grew up as an engineer.
Yeah.
Writing code a long time ago. And I was an engineer for a few years. And then I went into product management for a few years. And then I moved to the UK for a little while.
Oh, I didn't know that.
Yeah, I lived in the UK for a while where I was a technical architect designing telecom networks for mobile carriers in Western Europe and Africa.
Wow.
So I used to design these networks for carriers in Kenya and Tanzania and Uganda and Botswana and all these different places. And this is a time when these mobile money solutions were just starting to gain traction.
M-Pesa.
And M-Pesa, that's right. And so...
were you working with Safaricom or this is...
Safaricom was one of our customers,
okay.
But this was separate from M-Pesa. But I designed some of these mobile money solutions where you can top up your phone with airtime credit and then use that as a currency to make payments. And so that was the beginning stages of my entry into fintech, financial services, and ultimately payments.
And what period of time are we talking about? When were you living in the UK doing this?
Gosh, that would have been 2007, 2008.
Okay.
Or so.
Coming up on 20 years, my friend.
Gosh.
You're an OG.
I don't want to think about that. Yeah, that was back in the day. And then I got a call from a friend back in Canada to join this fast-growing company called Research in Motion that used to make these phones with keyboards called BlackBerries.
Right.
And so I moved back to Canada.
Moved to Waterloo.
I moved back to Waterloo, which is where I did my undergrad.
Okay.
And I joined RIM on the business development side.
How many years after university was that for you?
Not that long. I was in the UK for about a year and a bit.
Yep.
And after I graduated, and then I got this call to come back to Waterloo. So I was only gone for a year and some change.
Okay.
But when I moved to the UK, I thought I was going indefinitely. I kind of packed up my life in Canada and settled down in the UK, and I thought I was going to be there for years and years.
What did you like most about living there?
It was, the culture was awesome, but it took some time to adjust. When you first move to the UK, when you're young and you don't have any money, it is a tough life. It's hard. It's expensive. The city is quite big.
Yeah.
And getting around is, it's not easy when you don't have any money.
Sure.
And then about 6 months in, you start to realize everybody feels this way.
Mm-hmm.
And you sort of rally together to fight against the man. And then it becomes a lot of fun when you start to develop a network of friends.
Right.
And then it was great. Like once you have a close friend network in the UK, it's actually a lot of fun.
Absolutely, man. So it was fun times. Like you it was trial by fire. You got there, that's interesting because you very quickly, it sounds like you kind of like felt like it was home.
Yeah, almost right away. And actually, I'm a British citizen.
Oh,
so I landed in the UK and basically went straight to the office. So there was no visa issue for me. There was no immigration.
By birth,
my parents are British, and so I'm a dual Canadian and British citizen.
Amazing.
And so that allowed me the freedom to just show up in the UK and start working. And this was before Brexit.
I was just going to say that, yeah.
So I could freely roam around Europe and work anywhere I wanted in the EU.
Wow. And then you came back to Waterloo.
Back to Waterloo.
Little sleepy town.
Hey. Waterloo,
with a big university.
Sleepy.
Big university.
No, it was great. I came back to Waterloo and I joined RIM, and RIM was a fast growing, amazing tech company at the time.
Again, what year is that now?
That would have been 2008, 2009.
2008 still though, this is like post iPhone launch.
It was just around the time the iPhone launched.
Yeah.
And so it was still early days of the iPhone, and it hadn't yet made a huge impact in the smartphone space, given that BlackBerry was so dominant.
Sure.
It was only a year or two after that we started to feel the pain in a big way. But during that time, I was part of the business development practice at BlackBerry.
Okay.
And we were a sister team to the corporate development group. So we would often work on deals together, or things that weren't a fit for partnership, could be a fit for an acquisition or vice versa. So we'd work closely with that team. And we didn't have much of a presence, at least in the Bay Area.
Okay.
So I just raised my hand and said, I want to move out to San Francisco and be our corporate development M&A guy in the Bay Area. And so that's what I did. I moved out to San Francisco and I was the only guy from BlackBerry on the corp dev and venture team.
So there's no strategy for M&A at the company. Like you were driving strategy for M&A.
Well, we had an M&A team that was based in Waterloo, but we had nobody in the Bay Area. So I was by myself running up and down the peninsula, looking at companies for potential acquisition or investment.
Tasked with like budget and the ability to make things happen?
Yeah, we were buying companies off the balance sheet. We were cash rich at the time.
Okay.
And we bought a bunch of companies.
Do you remember them? Like what was the most the one that you have the most pride for?
I'm trying to. This is I was
It's a while ago.
Yeah, I was thinking about this. We bought Dash, which ended up becoming turn-by-turn navigation for BlackBerry.
Okay.
We bought a company that ended up becoming our application store. So what turned out to be App World for BlackBerry.
Okay.
We bought a company called the Astonishing Tribe, which was a UX upgrade to what we had built.
Now there's a pattern here.
We bought this. This wasn't a Bay Area company, but we bought a company in Ottawa called Qnix,
Okay.
which was it was Ottawa based, that became the operating system for BlackBerry's tablet device, the Playbook, and also got BlackBerry into OSs for cars. So Qnix was powering like BMWs and a lot of popular cars on the market. And with that acquisition, those cars were now running on a BlackBerry operating system.
Interesting.
Yeah. So anyway, we did a bunch of deals like that.
Yeah.
And then when the iPhone became incredibly popular, BlackBerry started losing market share, and we were not buying as many companies.
Sure.
And in fact, we started doing some divestitures of assets that we had previously bought. And so I ended up leaving the business and joined a San Francisco-based company called Xoom, which focused on
with an X,
cross-border payments. That's right, with an X, Xoom. And they were competitive to MoneyGram, Western Union, and guys like that.
Mm-hmm.
So friends and family remittances, sending money to mom and dad in India or the Philippines, Mexico, places like that. And we were backed by Sequoia and NEA and some of the Silicon Valley giants.
Mm-hmm.
Roloff from Sequoia was the chairman of our board. Keith Raboy was on our board. We had Kevin Hartz, who ended up becoming the founder of Eventbrite with his wife.
So not the short black comedian.
No, different Kevin Hartz. He was the original founder of Xoom. And so I didn't realize or appreciate it at the time, but we had a bunch of these Silicon Valley legends on our board and in the room.
Yeah.
And so when I joined shortly after, we took the company public on the NASDAQ, and it was a great success story.
What did you join as? What was your role?
I was running corporate development.
Okay.
So I led M&A for Xoom.
Wow. What a great, so far ride in your story, post-university.
Yeah.
Right place, right time, seeing some interesting
right
stuff
place, right time, and just willingness to say yes to opportunities.
It's a big lesson for people in the audience.
Yeah. Most of the things that I've done, I had no idea where it would take me. I just said, yes, let's try it.
Mm-hmm.
And Xoom was awesome. It was some of the best years of my life from a professional standpoint. And, so saying we took the company public, and then a couple of years after that, we were acquired by PayPal. And so it was almost like we went back home, because Xoom was actually born out of PayPal way back in the day.
And then it was spun out as an independent company.
Yeah, it was kind of like, hey, take this PayPal thing and see what you can do with it. And Peter Thiel was one of the first investors in Xoom, and David Sachs was an investor in the company. And that's what kind of got the business going. And so when we were bought by PayPal in 2015, it felt a little bit like we were going home.
Mm-hmm.
And
at that time, had it been sold to eBay or vice versa?
So
I don't even know.
So PayPal was a part of eBay.
Yeah.
When we signed the agreement to be acquired, But the time between signing the agreement and closing on the transaction, eBay and PayPal split up. So it was the same year that was happening.
Okay.
So by the time we closed on the transaction, we went to PayPal, and PayPal was a standalone publicly traded company. And so I joined PayPal. I joined PayPal on their corporate development, like M&A and venture team. So I was running those operations out of Canada and parts of the U.S., the East Coast of the U.S.
So where did you live at the time?
So by this point, I had met my now wife.
Okay.
And moved back to Canada because she was not able to move to California. So I decided to come back to Canada. Within 4 months of me moving back, we were engaged, and 4 months later, we were married.
Right.
And now we've got 2 kids.
Yeah.
But PayPal was an awesome experience as well. It was the place where we did huge, meaningful transactions that, captured the headlines. Like this was, we invested in Uber before their public listing. We invested in Mercado Libre in Latin America. We bought iZettle for $2.2 billion out of Europe. We did Honey for $4 billion. We invested in Plaid and Acorns and Tink and Toss, P-Pro, and a bunch of like really successful fintech companies.
I love hearing these names, though. They sound hilarious.
We were a team of 6 or 7 guys, split between San Jose in the Bay Area, Toronto, London, and Singapore. And we were, a team that just spent a bunch of money buying up companies and making investments.
What a thrill.
Yeah, it was a lot of fun.
Man.
It was a lot of fun.
And of course, this is like not on the legal side because you're not a lawyer. So
I'm not a lawyer.
I'm not, the fun bits of the deal.
I'm not a practicing lawyer, but I actually went to law school.
Oh, did you?
Yeah, I've got a master's in law. Somewhere in this whole journey, I did a part-time degree in.
You're such a keener
in law.
So you've been busy.
Well, I actually have another degree in finance, which I did part-time while I was working.
Okay.
So
you got the paper to back up your,
Well, I just never wanted to give up on learning and going to school. And so I figured if I can't do it full time, because that will be too disruptive for my career, I'll just punish myself and do it part time while I'm on the road and, doing these kinds of deals that I was describing.
Crazy. The finance degree is what?
It's a master's in finance with a major in economic policy out of the University of London.
Interesting. Economic policy. That's still pretty meta.
Pretty meta, yeah.
While you're doing deals buying companies.
Yeah. The law degree, there's a whole story behind that if you're interested.
Let's go there. What happened?
So I was at RIM at BlackBerry in San Francisco, and I had always wanted to go to law school, but I never wanted to be a lawyer. So I thought I could write the LSATs, apply to law school, and that could be the next path that I take. So that's what I did, and I got in. And right around the time I got an offer to go to law school, I got an offer to join Xoom. And so I thought to myself, well, Xoom is an awesome up-and-coming business that's growing really well. So let me go take that opportunity, see where it leads, and I'll defer on law school for a year. And if Xoom wasn't a fit for me, I could go back to school. If it was, like I could give up that spot a year from now. And so a year went by, and in that year, I got married. And while we were on our honeymoon, I got a call from the school saying, "Hey,
are you going to be there next week?
Are you coming?" Yeah, class registration
are
almost closed. are you coming? And in that moment, I just said, no, I'm going to withdraw because I was having a great time at Xoom.
Yeah.
But I always wanted to go to law school. And so I kind of was bummed about it and started looking for alternatives. And I found this program at U of T where I could get an LLM, a master's in law, while working full time and doing the degree part time.
Crazy. Okay.
But the deadline was like 3 months past. And so I just fired off a note to the associate dean saying, like, here's my background. What do you think?
Right.
And then I forgot about it. We came back from our honeymoon and I got this call from the school and it became this impromptu interview. And it went for a half hour, then an hour and a half. And we went through my entire background.
Sort of like this.
Yeah. And then at the end of it, they said, look, if you submit an application by midnight tonight, we'll convene the admissions committee and we'll let you know.
Wow.
So I got 2 reference letters that day. I wrote a personal statement that day. I had my transcripts already and I just fired it off. And the next day at around noon, they called me and said, hey, we convened the admissions committee. You're in. Classes start tonight. Show up and you'll get your books. And I said, okay, I guess I'm going to go to law school now.
It's interesting because like a lot of, I would assume people today in their youth, in their 20s, specifically maybe early 30s, because of experience, going to university during COVID at home or whatever, are probably kind of like YouTubing more than they're considering post-secondary education. Yeah. But what would you say, given, how things might have changed in the last few years about this whole idea of like loading your plate and getting degrees?
I mean, look, when I went to school, this was pre-AI, this is before ChatGPT, it was before Claude. You can learn a ton from these tools right now. And I was actually less interested in the credential itself. I actually wanted to learn the stuff because I went through engineering and engineering was more about surviving than it was about like, hey, let's absorb the material to the best we can.
Yeah.
I mean, we may say that that's what we did, but the truth is we went through the program and we just tried to survive because it was hard. But when I did my finance degree, I had a genuine interest in learning the material. Same thing when I did my law degree. And I was learning from some of the best teachers in the field.
Mm-hmm.
But nowadays, there's not really a barrier to go and learn that material. If your motivation is really to learn the content, there are tons of tools available to you where you don't need to spend hundreds of thousands of dollars or tens of thousands of dollars on tuition to go learn it.
Sure.
So had these tools been available to me at the time, I may have thought twice about actually going back to school.
And then was this like so where are we? Where you got your law degree? You're at Xoom PayPal.
Yeah. So the law degree happened while I was at Xoom before the PayPal acquisition. Once PayPal acquired the business in 2015, I joined PayPal. And so I was describing some of the deals that we did. And then in 2017, I got a call from a good friend of mine who runs a venture fund in Canada called Inovia. And Chris Arsenault, who's managing partner there, he's been a longtime friend, called me up and said, hey, Karim, there is a fintech fund brewing. You should be a part of it. And I have a tremendous amount of respect for Chris, but I told him I'm not interested in some small fintech fund. Like I'm at PayPal, we're doing big things.
Big boy.
The deals we're doing are exciting and interesting.
Chris, I'm a big boy.
And so I said, I'm not interested.
Yeah.
And he sort of said, look, no commitments, just have some conversations and see where it leads. You never know. So I said, fine. And so I got together with my now partner, David. And he had been working on this concept for a little while. And we started jamming together on what a fintech fund could look like. We talked to a few LPs and they said, hey, look, you guys are the right guys to launch a fintech fund, an early stage fintech fund. if you do it, we will bankroll you. And so that is almost an impossible experience to have as a new GP, where LPs are giving you cash without a long enduring process that came before it.
Right. You don't have to convince them to give you money to start spending.
That's right.
But also it sounds like there was a kind of a right time moment here because
100%.
So maybe you can describe why it was the right time and also who these limited partners were, if they're institutions.
Yeah. So
And why they haven't-
all of our LPs for Fund 1 are large institutions.
Yeah.
And
For example,
so we have CDPQ, or Caisse de dépôt, which is a large pension fund in Quebec. Desjardins, the largest credit union in North America.
right.
Sun Life became an LP. Industrial Alliance became an LP. BDC, Beneva became an LP for Fund 1. And it was great. Like, we were very, very lucky and fortunate to have these LPs. FSTQ is also another fund in Quebec that joined us for Fund 1. And a few of these LPs said to us, "Hey, if you start the fund, we'll bankroll you." And it was a kind of a magical, fortuitous experience to not have to go through a whole fundraise process. And so we decided, okay, I guess we're going to go be VCs and start this fund. And that got us $50 million right off the bat.
And how long did it take?
It was very quick.
It was like a couple of weeks.
Yeah, like
Having calls with
maybe a month or two.
Wow.
Because
they'd all allocated probably some money to this sort of utilization.
Yeah, they had an appetite to go and allocate capital for fintech.
Okay.
And at the time, Canada didn't have a ton of fintech allocators in the market. And so there was a gap, particularly at the early stages, where young companies who were building for financial services didn't have a lot of opportunity within Canada to go and raise capital. And so we tried to fill that gap. And so we raised $50 million off of, our backgrounds and support from early investors. We said, how much more can we get? We raised another 25, and then we said, how much more can we get? And we raised another 10. And so Fund 1, we closed at $85 million, and we started deploying almost immediately.
And then how long did it take to deploy all of that, get to the second fund?
Yeah, so that we closed Fund 1 in 2018.
Yeah.
And then we closed Fund 2 in 23.
Okay.
And so we deployed the first fund over about 4 or 5 years. And we've got about 20 companies out of that portfolio, Fund 1 portfolio. And, a lot of them have grown to become very successful. And we are continuing to support some of them as they as they grow. Yeah.
And now you're in Fund 3.
We're in Fund 2.
Fund 2. Okay.
So
2023 is when you raised it.
Yeah. So we did a first close in 23. We did a second close in 24. We've got 9 companies in that portfolio so far.
And what was the size of the second fund?
Second fund was just under $100 million.
Okay.
So slightly bigger than Fund 1, but not like massively bigger. But it allowed us to keep a similar thesis, just kind of upsize some of our initial investments to capture more ownership at the early stages.
What is that thesis?
So we back early stage fintech companies across the U.S. and Canada, and we typically invest in infrastructure companies, often what you would call kind of B2B.
Mm-hmm.
We do look at some B2C, but like our core focus is really in the B2B world. And that the landscape across fintech has changed quite a bit in the last 8 years when we first started deploying capital.
Right.
Because now, of course, AI is a thing.
Let's talk about that.
And let's talk about it.
So that's changing the pace at which innovation is able to be developed but also, or solutions are able to be developed, but also to be deployed and integrated with customers and stuff, right?
It has changed almost every aspect of how a company operates and the types of products that companies build. So if you look at companies pre 2023,
Right.
often you will look at their tech stacks and feel like, gosh, this already feels old. And 2023 was not that long ago.
No.
Because more modern companies have built an AI first agentic tech stack. They're using AI dev tools like Cursor or Claude to deliver on product development way, way faster than before. And so, back when we first started the fund, one of the biggest indicators of potential success was speed of execution from the founding team.
Yeah.
How fast can you acquire talent for the business? How fast can you deliver product? How fast can you acquire customers? And do you have the ability to raise follow-on capital in a timely manner so you can continue with your growth path? Nowadays, with these new tools, speed is almost ubiquitous for anyone who is motivated to deliver quickly.
Yeah.
And so
product development, you're specifically
on product development and on operations, because there's a lot of these tools that can help just make your internal operations of your business that much more efficient.
Mm-hmm.
And that often will lead to smaller team sizes. So not needing to hire as many people as a company would have, say, 3, 4, 5 years ago.
Yeah.
And so the old playbook of having a 30-person engineering team or a 10-person sales team, like those days are gone, because you can be a lot more efficient with how you build product and how you can acquire customers.
Okay, but the acquiring customers bit, how has that changed?
Well, you have tools that can make pipeline development a lot easier.
On the discovery and research side, but on the actual selling side?
Yeah, so you'll still need to have, in a B2B context, you'll still need to have people in front of customers describing what the product does. But a lot of our companies don't need to have the number of people that they may needed to have if this was a company from, say, 5 years ago.
Because it's high ticket sales.
It's not just high ticket sales, but each person can deliver more because they're much more efficient with the tools that they use.
That's happening?
So yeah. So what, one of the key metrics that investors are looking at these days is revenue per employee.
Sure.
And so it lends itself to a world where you have fewer employees delivering the same or more output, both in terms of customer acquisition and in terms of engineering.
But also comparing this, of course, to previous history with venture-backed companies, like you said, where the numbers would skew in favor of engineering, right? And you've got to throw a lot of manpower at coding and building scaffolding and unique approaches that might not be portable and all that, rebuilding things. And
that's right.
So efficiencies on the engineering side, definitely. Is that exciting? Because what this sounds like is that I don't know if the company, as an investor, are you finding that there is more to be excited about on the supply side of investment opportunities, like more young agile companies that are coming up with cool shit?
Yeah,
quickly?
the what I'd say is the bar for quality is a lot higher now than it was before. Not that it was a particularly low bar before, but it's even higher now because everybody has access to these tools, these dev tools, and can develop product really, really quickly. So the biggest question we are asking nowadays, which is true for most other investors, is around defensibility.
Mm-hmm.
Because before, your tech was in and of itself a meaningful moat on the business. Nowadays, that's not true because you can build a cool product in a weekend using Claude or Cursor. And that means that if you can do it, other people can do it too. And so there needs to be something else that's proprietary or unique to your business that is difficult to replicate and is long-term durable in order for it to be an investable company. So founders with domain expertise or have some unique insight,
Sure.
some unique or interesting distribution, access to data that nobody else has access to.
Mm-hmm.
Those are the types of things that we look for to say, okay, we believe that this company can be long-term durable.
Mm-hmm.
And so that often is infrastructure companies, companies that are, the system of record or the storage house of data where you can deliver insights or add-ons to that data that nobody then has access to.
Mm-hmm. Putting on your M&A hat it's dusty, I know, but like your M&A hat for a second.
Not that dusty.
How would you think large corporations looking to acquire agile new, companies, how are they looking at it? Because I would think they'd be licking their lips.
Well, a lot of these companies are built on legacy solutions. If you look at, we live in a world where our friends and partners and LPs are banks and insurance carriers and large financial institutions. And a lot of their tech is old and archaic and it's been around for a long time, not because they wanted to, but because in order to modernize, it's a huge endeavor, a huge, massive endeavor that can be crippling to the business if not done correctly.
Right.
And if you go back to what I was saying before, tech stacks that were built prior to 2023 are already feeling old. If you go back even
70s.
further, exactly. You go back to the 70s and 80s, those are not aging well at all in today's AI native world. And so what we're seeing is these large incumbents are trying to figure out what they can do in a world where AI is dominant. And so they're looking for technologies that can modernize how they do business, both on the operational side, but even in the products that they deliver to their customers. So they're looking for companies that have built a tech stack that's AI native, that they can say, hey, this is our entrance into an AI first world.
Yeah, because we saw this recently with, was it Scotia that bought Tangerine?
Yeah.
Scotia bought Tangerine. Now that might be positioning in market to kind of be a Wealthsimple competitor or something like that, like going after young first-time customers, the hip new bank. But also, Tangerine just announced a few weeks ago that they are essentially using a Renta stack. Like, I forget what it's called, but there's this British-based software
Starlink.
stack, right? They're OEM SaaS product to run a bank.
Yeah. So, and this, by the way, is not uncommon. A lot of banks are using third-party technologies like Fiserv or FIS as core infrastructure under the hood. So it's not as crazy as you may think, because when banks first started, they were not technology companies.
Sure.
They needed technologies in order to keep up with customers' wants and needs as they evolved over time. And companies like FIS and Fiserv and Jack Henry were all businesses that filled that need at that time. But those tech stacks are even old now, and are due for some modernization. One of the things that we are starting to think about is, like I mentioned before, long-term durability of these companies.
Yeah, are these companies just a software exercise?
Right.
Or are they an actual company?
Right.
Now, is that about, you tell me, how do you assess that?
It's very hard. It's very hard. And we think a lot about replicability of a lot of these new companies because they all use the same tools to build product. And so I was sort of saying before, we look for proprietary data or infrastructure or systems of record, um, or companies that have unique network effects.
Yep.
That is not predicated on the tech itself being strong, but the non-tech assets of a company that make it strong.
Right.
And one of the areas that we are now starting to spend more time on is companies that invoke something that happens in the physical world.
Okay,
So
interesting.
the physical world is an area that is relatively untapped from an AI perspective. So you think about the AI tools that exist today, they're all language models, right? They are not physical world models. And so we're starting to think about companies that use software to invoke something that happens in the physical world, or AI layers on top of the physical world to help you understand it better.
How does that tie into the world of finance?
Yeah, so financial services has typically been a software-oriented world, right? But we have a company in our portfolio called GeoLava, and they have built a world model.
Lava, like the magma, or lover?
GeoLava, like the hot molten rock that comes out of a volcano.
GeoLava.
And these guys have built a
social network for nudists. GeoLava.
They've built a physical world model for large commercial real estate investors.
Okay.
To assess properties, physical properties, by ingesting a ton of data about these properties. So they'll take satellite data, thermal data, street view. They're plugged into municipal data, compliance data, and figure out this structure at 123 Main Street. It has a value of $100 million, and is projected to grow at this rate. And it can say the quality of the roof, it looks like this, and there's some structural damage here, or there's a structure on this property that is out of compliance.
Yeah.
Or there are power lines that are close to the property. And these are all things that would ordinarily require somebody to go and visit the site in order to do these kinds of assessments.
And even then, they might not get that level of complexity.
Even then, they may not get the data. So this allows a commercial real estate investor to quickly analyze a property and start making decisions and assessments about that property. And you can do things like bring your own data and say, hey, I have a portfolio of buildings across this zip code. Find me another building that has similar characteristics to the ones in my portfolio in this other zip code. And it can grab the data from your portfolio and use that as a guide to find you properties with similar characteristics.
Do you think these new complexities facing like startup formation and the software-based company formation, are they going to mean that you'll have to change your thesis as an investor?
I just think it means that we will need to evolve our thesis. And that's just true for any venture fund. Like, the world is not static. It changes over time. And a venture fund has a typical lifespan of 10 years at a minimum. And that is an eternity when you're talking about tech evolution. So if you look at the stuff that...
Wait, when you say that the lifeline is 10 years, that means per fund, the payback cycle, or like when you'll say you're going to hit your big win.
Typically you are deploying capital into new companies over a span of 3.5 years, or 3 to 3.5 years, something like that.
Yeah.
And then you help these companies grow for a few years, and you're starting to look for liquidity, taking exits on your position, kind of starting year 7, 8, 9, and hopefully by the time you reach year 10, you're out of your position and you've made all your money.
Sure.
That is almost never the case. There's usually extensions that happen on these funds. But the point I'm making is the lifespan of a fund is very long relative to how quickly innovation is happening in the tech space, particularly now with AI evolving literally every day. And so it forces us as investors to rethink and evolve the way we look at companies and the characteristics that we put value on. Because what we thought was highly valuable 8 years ago is very different than what we think is valuable today.
Namely, labor and the type of IP around the software.
Yeah, efficiency, labor, how you build product, speed to market. Speed to market on product development was a big indicator of founders' ability. And now that you can deliver products to market really, really fast, it's no longer an indicator of the caliber of a founder.
What do you think about market building or the ability for people to perceive markets that have not been exploited yet?
Yeah, I think there's a whole world of market opportunity that is just becoming available. And there's many markets that still are not visible to us yet.
Sure.
The entire world of how AI tools are built, for example, like we are now used to years and years of SaaS type business models, where in today's AI world, consumption of compute is the biggest driver of AI cost. So it's challenging for a company to bill you on a monthly recurring basis and say you have an all-you-can-eat type model.
If their costs are fluctuating.
Based on your consumption.
So isn't that terrifying? Like, I wonder about this, right? Now, there's caveats to this logic. Like, 20 years ago, people, when they were just being educated about the nature of the cloud and whether you should put your stuff in the cloud and your software, your SaaS products, is it safe running in the cloud kind of thing. It was all the same fears that I'll raise. But on one side, what I understand, you can please illuminate and add to this. But on one way of thinking, I think there are there's this question of kind of like tools being built using AI that rely on these AI platforms. The question of how unique is their value prop when the platform can actually offer the same functionality to all users. There's that kind of like threat. But then there's also this other side where people are using the tools to create code, and the code can live anywhere and be taken off the tool that created it, right? So it just becomes a development tool as opposed to the actual software.
Yeah.
So as an investor, I guess, how do you differentiate between the two? And also, like, how do you come, like you said, you come from engineering and you're savvy to the law and finance. So you might have a deeper insight compared to other investors that, will not do diligence on code and see how the soup is made.
Yeah. So, I mean, like I was saying before, the actual code or the tech is becoming less and less valuable as a differentiator. So, yes, you need to have well-written code, but these tools that help you write the code are getting better and better. So the code that it's producing, over time is becoming better and better. And so you can start to rely on the quality of that code. Now, don't get me wrong, you still need a human to check that it does exactly what you want it to do, and you need to check it for quality, but that quality is getting better and better over time. But the idea that a company can last and survive and thrive based on the fact that their code is written well, that notion is done.
Right.
Because if you can build code using Claude or Cursor, that means somebody else can. And if that's true, that means everybody else can.
But how different is that? You know, like how new is that? Because I felt like when I was developing solutions for clients using PHP and MySQL, but using scaffolding like 20 years ago
Sure.
almost, the scaffolding gives you the leg up to be able to, or like, you know, Ruby on Rails and all that.
Yeah. So the thing is that these tools allow you to move really, really fast and produce output at a much higher velocity than before. So, you know, there was an old saying or an old question that VCs used to ask founders, couldn't Google just build this? And the answer to that question was almost always yes, but they won't. Because the cost for a large company to go and build the thing that that founder was building
Yeah,
was very expensive and would take a lot of time.
sure.
Now the question isn't, hey, can't Google just build this? The question is, can't Anthropic or OpenAI just build this?
Right. Or Google.
And yeah, or well, yeah, actually, that's true, and or Google. Um, but the answer to that question now is almost always yes, they could, and they
Right.
might,
Right.
because the cost for them to get into a particular space is not that high. And so there's a lot of concern amongst early stage founders that, hey, if we start down this path and we invest our time and energy and we raise capital, and one day
Yeah.
Anthropic makes an announcement that they're launching a similar product, how do you compete with that? I mean, they are effectively a bottomless pit of cash. And to fight against that is really, really tough.
Right. Right. Yeah. It comes back to this idea of brand. It comes back to this idea of relationships. It comes back to this idea of monetizable trust.
Yeah, and it comes down to, can you build assets that are hard to replicate and even hard for the language models to replicate?
That's one way of looking at it, right? The defensible IP kind of thing. Like how unique is your thing and how do you use the platform, the LLMs to help you or whatever your code
Yeah.
assistant to help you build it, but not own it entirely on the platform, blah blah blah. But the other thing is like again, like you said, in how you're assessing the value of potential investees is to say, you know, what's their path to market? What's
Yeah.
their unique perspective and access to market?
Yeah.
Those things are really interesting to look at now because if software is freed of software or the software industry is freed of software, there's limitless potential to create value.
Yeah.
And whether that value can be monetized in such a way that a company can build itself and grow to exponential gains
Yeah.
is the larger question.
Yeah. I mean, look, we've got a company in the portfolio called Mycroft that helps companies become compliant with regulation. So they help companies become SOC 2 compliant. They will also help you with your cybersecurity posture, making sure that you're safe against hackers. So they'll do cloud vulnerability assessments. They'll do penetration testing. They'll do mobile device management. It's kind of like this all-in-one cybersecurity, compliance, and IT in a box.
Mm.
And it's all driven by AI and agents to help you perform these tasks.
Yep.
And so in a world where efficiency is really important, these guys can come in and help companies who don't have an IT team be their IT team, or companies that would typically require a 5 or 10 person IT department
Yep.
to have a 1 or 2 person team. And they've built something unique and interesting because of the insights that the founders have in their experience having done this for a decade and a half. And they can bring that proprietary knowledge to the product and build it in a way that they know is going to be compliant with the regulations.
Mhm.
They know that they can find these vulnerabilities in a company that would otherwise be really difficult to find and remedy. So they have this unique proprietary insight that they can bring to their product, and that helps them become durable long term.
Let's change tack and double click on this thing that like you were saying your fund invests in the US and Canada.
Yeah.
What are you seeing? I know we're very different countries, etc. But what are you seeing? Well, no, I'm glad that you're here for me to ask this because as you've painted the picture, you've got perspective working across the pond as well, and you've seen Waterloo in a birth stage or some form of that with RIM. But what are you expecting from the companies that are within your investment portfolio kind of thesis from Canada in their ability to emerge and be relevant on a global scale versus the ones that you're seeing, down south?
I mean, look, when we invest in a company, we are betting on that particular company. So yes, there are macro level trends that we look at, but at the end of the day, we're betting on a particular horse when we invest.
Okay.
And
so
that
doesn't matter where they are.
Well, to an extent, it doesn't matter where they are, because we're looking for the best founders, whether they are in Canada or they're in the US. And we're looking for companies that have the potential to become the best in the world at what they do. And because we invest at the early stages, that usually means we are over-indexing on the caliber of the founder. And look, one of the things that we pay a lot of attention to, especially now, is the founder's ability to adapt to modern times. So we tend to have a bias towards repeat founders, and a lot of investors will tell you that they have a preference for founders who have been there and done that and have seen the pitfalls and have learned how to build a company to become massively successful, know how to run operations, know how to raise capital, know how to attract talent, and build something that's long lasting.
Yeah.
But the playbook,
long lasting or yielding?
I mean both.
Yeah.
I often those two things are hand in hand.
Should be.
But the playbooks that founders used 3, 5, 7 years ago, in many cases, don't apply today. So, if you're a founder who's used to the playbook where you need to go and have a big engineering team or a big sales organization or a huge operations team internally, big compliance group, like that model doesn't work as well today.
Right.
Because you now have tools available to you where it's unnecessary. And so founders will, if they're running the old playbooks, we think at least they're making mistakes today that they wouldn't be making 5 years ago because the playbook is different. So we look for repeat founders, yes, but we look for ones that have a mentality of adapting to how the world exists today and changing their operations in their business for that.
I gotta ask, like, for that profile of founder, the second, third time round founder, who's necessarily, I mean, by that, understanding of exit, right? Like those founders, if you've sold a company, you've sold a company. And if you've sold 3 companies, you've sold 3 companies. Sold 5 companies, you've built possibly 4 of them to sell. So how are those people looking at what their opportunity is in today's economy for exits, and how does that change the nature of the companies being built? Are we seeing this move away from IPO track $1 billion companies into people setting their sights on the like $100-200 million acquisition targets?
I mean, I hope not. Look, the greatest founders have the biggest ambition. And for us as venture investors, the math only really works out if we can
big win.
Yeah, if we can back founders that have the huge ambition to turn their business into something massive, right? Otherwise, if we're looking for companies that generate smaller outcomes, the math to be a venture investor just doesn't really work. And so we backed a company out of our first fund called Flinks, which was founded by two awesome guys, YG and Fred. And I was lucky enough to sit on the board of the company. We helped take them through 3 rounds of funding and ultimately sold the business to National Bank.
They've bought it? I thought they just invested in it.
National Bank acquired the majority stake of the business, effectively an acquisition, in 2021, and the founders have started a new business called Deck, which we backed at the seed stage, and we had an unfair advantage because we knew these founders. We knew how they think. We knew how they operated. We knew their mindset towards how technology has evolved since the time when they built Flinks.
Yeah.
And
that was a Fund 1 company originally, Flinks?
Flinks was a Fund 1 company. Deck is now a Fund 2 company.
Okay.
And these guys are excellent. They are very quick to move and use the new innovations in AI to their advantage. And so, the core of their product today is to aggregate data from data sources that are hard to aggregate. So websites that don't have an API that you can easily plug into,
sure,
using a user's permission to access their data, they can pull that information and make it usable for other applications that a developer builds.
Okay.
So it's a dev tool, really, where you can build applications on data that's typically hard to get.
Nice.
And
so this is like scraping information or ingesting it and then using the magic of AI to create these relationships with data and structure it.
You can build an application that uses payroll data, for example, or rental data from properties, music royalty data. You can go and pull that information and build an application that uses that data for something. And the company is growing incredibly well. But it's really because the founders have adopted their mindset to operate in an AI first world,
right,
compared to the time when they built Flinks, which is pre-AI. They were really, really strong at that time in how to build their business. And since then, their mentality has changed to hey, we need to leverage the tools that are available to us today to build this new company.
That's exciting, man. So see, this is cool. You've already worked with, is that the only example of a foundation team that you've seen in the last 2 funds build something new?
That's just one example of a company that we backed in Fund 1 with founders who we backed again in Fund 2.
Yeah.
But there are countless founders who are veterans in the sense that they've built companies before, but they are now building something new in an AI first world and demonstrating their adaptability.
Speaking of adaptability, are you a lifelong VC, do you think?
I would like to think this is the last job I'll ever have.
Okay, so you would never start a company. You have a company. I shouldn't say it like that.
Yeah, I mean, look, we're venture investors, but because we founded this firm, we also kind of behave like founders, and we go through a lot of the same things that founders go through. And now, Don't get me wrong, founders of product companies and tech companies go through a ton in terms of stress and turmoil and loneliness. They're building up teams and raising capital, and they're thinking about a million different things. Now, we're thinking about a million different things, but at least from our perspective, once we've raised a fund, our revenue stream is somewhat predictable. And so we don't carry that same level of stress.
Right.
But we do a million different things. We wear a bunch of different hats and play. We play similar roles. So we are founders to that extent.
And I think similarly, it looks like the LP picture, is evolving, right? It's not the same game as when people were inviting you to take their money.
Yeah, it's just like anything, the LPs and their way of thinking is evolving as well. We have new organizations and individuals who want to become LPs. In Fund 2, we expanded our LP base a little bit. We also brought in a few individuals who were strategic or friends of the fund, or individuals who could be helpful to us and to our portfolio companies. And we'll probably look to expand that as well in Fund 3, bring in other perspectives from other LPs who can be helpful to us, and for whom we can be helpful, and just continue down the path.
Competitiveness to get into deals, is that an issue anymore?
Yeah, being competitive, or the competitive landscape is always an issue.
So good investment. It's a good investment.
Yeah, and there are lots of venture funds out there. Some of them better than others. But as venture investors,
oh shit, just tell me.
I'm not going to name names. But it's always competitive.
Yeah.
Because high quality founders and great companies will always attract a lot of attention from great investors. And so it's our job to make sure that founders get value from us beyond the capital. The capital is easy, right? Like lots of venture funds have capital to deploy. It's what you get with that capital that sets you apart. And we're specifically fintech investors. We come with operating experience. We've built products before. We have an awesome group of LPs that are strategic in nature that can be helpful to our portfolio companies. And when founders come and talk to us, almost always they can skip to slide 8 instead of having to educate us on the market and the background and what payments is all about, or what insurance is all about, or what wealth management is all about, because we have that background already. We have the expertise, so we can say, let's skip ahead to slide 8 or 9 and let's talk about the meat and potatoes of your business. And that they appreciate that a lot, because we can speak a different language to them than other investors understand the domain.
Yeah, pitching cold's a pain in the ass.
Yeah, especially to somebody who doesn't know what you're talking about, and you have to bring them on a journey to educate them about how payments works. Or
especially because, like, I don't know, this is a long time ago, having played that role, you end up finding very quickly as you start pitching VCs that most of them would never be your customer. So explaining the value of what you're bringing to market is really difficult, because you should instead be explaining perhaps the business model of the company.
Yeah, that's true. And our philosophy is, wherever it's possible, we want to be customers of our portfolio companies. Like, we're a customer of Loop. We're a customer of Pluto. We are a customer of Aya. So wherever it's possible, we will try to become a customer of our portfolio companies.
Yeah, that does sound like a rare place to sit.
Yeah.
Okay, and then a couple other, because I didn't know where this conversation would go, and it got quite interesting talking about AI and the fund itself and being a VC.
Yeah.
Do you find yourselves across Canada, or I should say in Canada and in the US, because this is where you invest, the stature of the fund in terms of attracting inbound versus going to find deals?
Yeah, we get a ton of inbound opportunities. But if I'm being totally honest, the best deals really come from ones that are referred to us by people who are close to us and we trust.
Yeah.
So that could be other venture funds that we've worked with, know and understand our approach. It could be investment committee members. It could be sometimes LPs. Sometimes it's people from our own network. Like I've spent a bunch of time working at Xoom and at PayPal, and a lot of those people have moved on to become venture investors or operators at other companies, or founders themselves. So that's often a source for us.
Right.
But the truth is, we also find really, really high quality deal flow for companies that we source and outbound to. So we track a ton of different founders and a bunch of different companies, and we have internal proprietary tools that give us signaling on like, hey, this person at this company is an excellent product manager, and maybe they're about the right time to. They've been at this company long enough where they might be thinking about starting their own business. Let's make sure that we know that person super well.
Wow.
And sometimes we'll build relationships before founders are actually founders. And though that's the best kind of relationship, because you get to know them well ahead of when they are actually raising capital, so that by the time they're raising money for their business, you can move relatively quickly through diligence because you have an existing relationship. And like I said before, we over-index on the quality of founders, and you usually require some amount of time in order to gauge whether a founder is high quality or not.
Mm-hmm.
It's really, really difficult to judge someone's personality, their capabilities, their ability to attract talent and capital and customers if you've only really met them once or twice, or a small handful of times. It's the longevity of your relationship that gives you exposure to that person's caliber.
What would you recommend also to first-time fundraisers that might be, coming to Luge or otherwise looking for investment from other people in preparing collateral that could be digested to get to know them?
Yeah.
Like how do they express who they are to the world in a way that makes them palatable to investors?
Yeah. I mean, like, when we go through a process of diligence, we look at materials that are in a data room. We look at investment decks regularly. We look at cap tables. We look at financial models, sales analysis, and customer acquisition cohort analysis, and contract sizes, so ACVs, and how they have evolved over time. But the truth is, the first thing that really matters to us is the personality of a founder. Now, all of your materials, the collateral that you're talking about, they need to be professional, well put together, easily digestible. We need to understand how your business works and what are the mechanics that grow your business over time. Like, that's super important to make sure it's clear and easy to consume.
Mm-hmm.
But before you even get to that stage, who you are as a person, what drives you, why are you building this business,
right,
what motivates you, what's your ambition, those are the things that we first look for. Have you done this before? If so, what have you learned over that journey? I sometimes say one of the hardest things for us to do as investors is predict how founders are going to behave in any given situation, particularly when shit hits the fan, because it will. Like, inevitably something will go wrong in a business. It always happens.
That's the nature of business.
Yeah. And is this founder gonna throw their arms up in the air, get flustered? Are they gonna scream and yell at their staff? Are they gonna start hiding things from investors? Are they gonna retreat and become incommunicado? Like, those are bad things.
That happens all the time.
It happens, right?
Yeah.
And so our job is to try and predict how they're going to behave in those situations. But equally, founders need to predict how we are going to behave in those situations. So we always tell founders when we're talking to them, do your homework on us. Talk to our portfolio companies, talk to our co-investors, figure out if shit hits the fan, what we're going to do. Are we going to throw things at your head? Are we going to scream and yell at you? Or are we going to roll up our sleeves and be supportive and help you navigate these tough situations? Because it's a mutual relationship. And if the founder does something bad, it's bad on the relationship. And if we do something bad, it's bad on the relationship.
It's so interesting being an operator who's bootstrapped and like having to, like slash my way through the jungle. It's a really funny thing because whenever I talk to early stage venture or startup guys, I'm like, you know what? There are stresses in business that you just don't have. So it's hard, I know, when it's a first time founder, but like once you've been through it, and this is the other thing, once people have been through it before, no matter how they funded their venture, the ups and downs and the lefts and rights, like once they've been through that stuff, they're hardened in a certain way to be able to deal with those things as a fact of business, not as she broke up with me.
Right.
And I want my MacBook back.
I mean, look, this is the origin of.
Sorry, that's a real story.
This is the origin of the name Luge. Like luge athletes are a little bit crazy. They go through twists and turns. You go through a whole bunch of stress as a luge athlete gearing up for your run. And we see founders the same way. Yeah, you go through a whole bunch of turns and ins and outs that sometimes are not predictable or are hard to see. And to even start the journey, you have to be a little bit crazy.
You have to be crazy.
It's irrational to go and start a business and compete against others who may be more capitalized than you, have a bigger brand, have a bigger staff, and you're out there, like you said, in the jungle, you're fighting. And it's lonely, it is stressful. If you have a family, it's hard on the family.
Sure. Yeah.
And you often don't have anyone who can share that experience with you in exactly the same way.
Right.
And you feel it in your soul when you are days away from missing payroll and you're trying to get an investment deal across the line.
Oh my God.
That's a kind of stress that you cannot understand unless you are in it.
And for anyone listening who that, situation is like personal to, this is why being able to sell stuff is important.
Yeah.
Right from day one, with any founder who's starting a company, know how you sell your product or service and be able to do it as early as possible so you can get cash when you need it.
Well, there's two sides to the coin. There's being able to build a high quality product that people want and solves a real problem.
Sure.
And then the ability to go and sell that product for something meaningful and sustainable that turns it into a massive business.
Right.
Those two things are critical for the success of the business. Now, making sure it runs operationally strong, also important. Making sure you bring on the right talent. Those are all ingredients to make the business successful. But you have to have an excellent product that solves a real problem, and you need to be able to sell it.
And that first side of it is becoming easier with AI, apparently.
It's becoming easier and easier to build product, yes. But there are still massive problems that exist in the world that need a solution. And sometimes, many times, those solutions are complicated.
Sure. Thanks for spending time, man.
It was great. It was a lot of fun. Thanks for having me.
My pleasure.